Hey traders, Jason here from Leavitt Brothers. Happy Sunday. In this video, I'm going to do an update on my State of the Market series. First, a quick announcement. I'll be speaking at the Traders Expo in New York, which is in 2 weeks. If you're around, check it out. Come say hi. I'll be talking about using sector rotation to outperform the market. It'll be at the Marriott at the Brooklyn Bridge, March 7th, 8th, and 9th. That's a Saturday, Sunday, Monday. I'll be speaking at 5:30 on Sunday night. Registration is free, so come check it out. All right, so in today's video, I'm going to do an update of my state of the market. I'm going to talk about the current state of things. Long term, market is in great shape, but short term, there are definitely warnings. In fact, I'd say something just doesn't really feel right in the near term. Okay, so let's go through some charts. So here is the S&P monthly. Okay, overall looks really good. You can see, breakout here, pause for a couple months, and then rally up. You got a breakout here, pause for a couple months, breakout, and rally. So overall things look good. Okay, barring a massive meltdown next week, the S&P will close positive for its fifth month out of sixth. It's got a pretty good gap or distance between itself and its 10-month moving average, which I consider to be a pretty good line in the sand. It could visit that, but it's got a nice buffer. So long term, S&P is in really good shape. Even if the market dropped 10%, this chart would maintain its bullish stance. Okay, so long term things are in good shape. Here is the global Dow chart. Okay, so like half this chart is the Dow, half this chart is the U.S. and the other half is global markets. So we know the U.S. is doing well. If the rest of the world was not doing well, this chart wouldn't be holding up as well as it is. Okay, so obviously the U.S. is doing better, but it looks like the rest of the world's doing pretty darn good too. So I actually think this is an extremely bullish pattern longer term. You have a huge cup here. Okay, and then if some sort of a handle forms here, it really projects for a breakout there. Now this handle could come down and test here and go like this and go like this and go like this. Okay, it could just trade sideways in a range. We can get like just a big pullback. Whatever happens, as long as it maintains a decent level over here, and it could last several months. It could go 3 or 4 months in order for this to form. As long as not too much damage is done, a subsequent breakout would be extremely bullish, would probably unleash like a worldwide rally. Okay, I consider the overall structure of this to be very good. For it to rally up, big cup, start to form a handle at a decent level. If that breaks out long term, that looks fantastic. Okay, so overall the market's in great shape, and as of now, I'd fully expect the uptrend to continue, but in the near term, something seems off. There are definitely a lot of warnings. Okay, so here's the S&P daily. Higher highs, higher lows, doing really well. Okay, you got a breakout. You got a breakout here. You got a rally, pullback, rally, pullback, rally. Rally over the pullback over here was shallow. The pullback here came all the way down to the 50. Would be considered a pullback within an uptrend, not a big deal. And now we're getting a little bit of pullback again. One thing I do notice here is that this rally lasted 2 months, and then we got a 2-day pullback. This rally lasted 7 weeks, and then we got a 6-day pullback. And now this rally only lasted 2 weeks. Okay, so each rally, here's a rally, here's a rally, here's a rally. They went from 2 months to 7 weeks to 2 weeks, and each pullback, that went from 2 days, 6 days, and who knows what will happen here. So each successive rally is getting shorter, each successive pullback is lasting a little bit longer, going a little bit deeper. Okay, that's most noticeable to me, but otherwise, obviously this thing is trending up, it's doing really well. The S&P could fall all the way down to here to the 50 and still be considered in good shape. So even though last week didn't really feel that good, something seemed off. Back up, look at the 12-month S&P daily chart. It's doing fine. All right, here is the S&P hourly. Okay, as you know, I considered the 50 moving average on the hourly chart to be an important kind of dividing line, and you can see it rode the 50 up all the way through here. A little bit of noise there. Okay, got trapped under the 50 over here, went above the 50 and got scooped up, rode it up basically all the way, and then as you can see, it got trapped below it again. Okay, and then it rode it up, and now last Thursday it dropped below it, and then with Friday's gap down and weakness, it's below it again. So in the near term, as long as it's below, as long as the S&P is below its hourly 50, I'm going to consider the short-term bias to be to the downside. Doesn't mean I'm going to go short, but it means I'm going to protect my longs. I'm going to be much less aggressive going to the long side. Overall, it looks good, but until hourly comes like this, and who knows, maybe it comes up and gets rejected, and maybe it finally gets above and comes down or tests and finally goes up. Who knows what the sequence will be? I mean, the hourly could roll over like this, and it could get rejected. We can have like a little mini downtrend. Don't guess. Let the market tell you what to do. But as of right now, the tide has turned in the near term. Biases to the downside. All right, let's look at some indicators now. One more chart of the indexes. All right, so we know that here's the Nasdaq, here's the NYSE. The market does best when these two are on the same page. Okay, as an example, if they're both trending up like this, trend continues, everything is great. Here we have Nasdaq higher high, NYSE lower high, market fell. Here we have lower low. Here we have higher low, market bottomed. And here we have a very obvious higher high from the Nasdaq, lower high from the NYSE. Okay, the market does best when these two are on the same page. It doesn't matter which one is leading or lagging. It doesn't matter if it's at the top or bottom. Whatever is happening tends to continue happening as long as they're doing the same thing. When they switch and they don't match each other's movements, then you tend to get a reversal. And that's what's happening right here. A very obvious divergence between the two. Okay, it's another reason why I don't think the short term seems to be very good. Now let's look at some indicators. All right, so here's S&P 500, 10-day moving average of the NYSE AD line, and then the regular AD line below. So looking at the AD line below, obviously trending up, higher highs, higher lows, above the 50-day moving average. Longer term, the market looks really good. When the market is in trouble, what happens is this will drop below the 50-day moving average. It'll come up and get rejected by it because this thing will kind of swoop around, and it'll get trapped underneath the 50. In the same way that the S&P hourly gets trapped under the 50, the cumulative AD line will do the same. Okay, so you often get some sort of divergence at the top. You get it trapped under the 50, and it starts trending down, and that's when you really run into problems. Okay, but for now, obviously, it's just trending up. So divergences here tend to pick local tops. Okay, so you have market higher high, 10-day lower high, market falls. Market higher high, higher lows, but you get a divergence here down to 0, and same thing, market falls. So we had a divergence here, which was part of the reason why the market fell at the end of January. And now I guess you can say on the bigger time scale, you have a bigger divergence. But more telling to me is just the fact that this is already down to 0. Okay, we're only 2 days removed from an all-time high, and yet this indicator is already down to 0. If we get a drop below, okay, if this starts going down here, then we're going to get a bigger drop, and then if it gets, if it hangs out down here, then then the drop's going to continue. So right now, I'd say there's like a warning is being flashed, and how this thing acts when it gets down to 0 is going to be very telling going forward. So right now, definitely warning signs, short term, long term, no problem. Okay, here's the S&P 500 up top. Percentage of stocks above their 20, 50, and 200-day moving averages. Divergences here tell us that participation is waning. Okay, market moves up. There's a percentage of stocks that trade above the certain moving averages. Market moves up again, and if many less stocks are trading above moving averages, we're told that breadth is starting to weaken, participation is declining, and you tend to get pullbacks. Okay, whether it's a big pullback or a small pullback, we don't really know at first, but it does tell you that the market is weakening internally. So for example, here we got market going up, percentage of stocks above their 20 moving down, percentage of stocks above their 50 moving down. Okay, same thing here, market moving up, higher highs, higher lows, percentage above their 20 moving down, percentage above their 50 moving down. Okay, so here we go again. Market moving up, percentage of stocks above their 20 moving down, and then move down again, percentage above their 50 moving down. Okay, so all this is telling us is, when the market was here, you had a certain number of stocks trading above their 20 and 50. Now the market's trading at an even higher level, but there are, less stocks. So, over here you had 80 something percent, and down over here you only had 60%. And that's a big deal. I mean, 20% times the S&P 500 is over 100 stocks. Okay, same thing over here. You got a drop from like 85 down to like almost 60. So there's like more than 100 stocks in the S&P that are no longer trading above their 50-day moving average, despite the fact that the index legged up again to a new high. So breadth is weakening. Near term is questionable. Here is the S&P 500 versus the NYSE new highs, NYSE new lows. Just going to point something out really quickly. So the new highs are doing really well. Okay, they're clicking in at a pretty strong level. They've been like that. There have been some stiff drops, but a stiff drop here or there is no big deal. Overall, it's doing really, really well. But you do have an uptick in new lows. Okay, so when you get a strong print in new highs and new lows start to move up at the same time, it's kind of Hindenburg omen-ish, where you shouldn't have the market either should be either moving up and you get new highs, or should move down, you get expansion new lows. But when you have both new highs and new lows expand at the same time, you get the kind of that barbell market where some stocks are doing well and some stocks are doing poorly. Tends to be a little bit of a warning. So something to keep your eye on. Nothing urgent, but it's something that is starting to develop. All right, here is the S&P 500 versus the 10-day of the put call. Divergences here tend to coincide with the market topping. So you got higher high here. We get a rounded bottom, a little bit of a rounded bottom, higher low here, and it breaks out of this box and moves up, and it coincides with the market falling. So you get a higher high here, and you get this nice W pattern here where a higher low is put in place. And then it breaks out, and that coincides with a drop here. We're getting the exact same setup here. We got market going higher high. We got a little bit of a W pattern forming, higher low. So if this thing moves up, breaks out of the box, most likely the market's going to come down here. Don't know if it's going to correct a week or a month, but it's not going to. The market's certainly not going to rally in the face of the put call going up like that. All right, here we have S&P 500 up top. We have the average true range, second, Bollinger bandwidth, and VIX. Okay, so the market likes to move up slowly, calmly, lack of volatility, and then it moves down quickly, fast, more volatile, bigger range, more energy. Okay, so bottom from the average true range tends to coincide with the top from the market. Okay, same thing with Bollinger bandwidth. Okay, so bottom here, top here, bottom here, top here. So recently we had a bottom and then it moved out of this bottom, as you can see. So that coincided with this little bit of a dip here. Okay, now it seems to be basing at a higher level. So instead of when the market legged up here, okay, when it legged up, instead of this falling all the way back down to its lows, it actually maintained its level, which is a little bit of a warning. Okay, so it's a warning in the near term. Now, if we look at Bollinger Band situation, it's the same. When you get like low prints, they coincide with the top. And we've had, relatively good, relatively low prints for, a couple of months now. Okay, it's not going to go to zero because obviously it's mathematically it's impossible. But we're only, we're near a 5-month high here. So even though the market's, only 2 days removed from its all-time high, Bollinger bandwidth has expanded. It is matching its 2 previous highs and a little bit further here, and we're going to have a breakout from this 5-month basing pattern. And if that happens, the market's going to drop. Okay, and then you can see here the VIX is also moving up in the near term. So it seems like instead, the market wants to move up on calmness, on lack of volatility. It seems like the opposite is happening. It seems like average true range is expanded, Bollinger bandwidth is expanding and about to break out, VIX is moving up. All right, so I am playing it very safe right now. Okay, I don't like what I see in the near term. Something seems off. If I'm wrong and the market surges next week, so be it. I'll miss some opportunities, but I just don't see a reason to be super aggressive. In fact, I don't even see a reason to be moderately aggressive. If you ever wanted to take a little time off, I think now is a pretty good time. Market has rallied almost uninterruptedly since early October, starting to get a lot of warnings in the near term. Long term, the market looks fine, but in the near term, I don't see a reason to be real excited about the opportunities that are out there. Thanks for listening. You can follow my YouTube channel by clicking the red subscribe button and come say hi. Register for the Traders Expo and come say hi if you're in New York. I'll see you next time.